Thanks for joining us today on The Close. I'm Marella Fernandez. Markets close in 60 minutes. Let's get to the stories we're following in the BNN Bloomberg newsroom. The Bank of Canada says the country's financial system is doing well despite multiple challenges. It says American tariffs, the war on Iran, and AI-related risks all pose threats to financial stability. The central bank also warning of rising valuations of financial assets, as well as the increase in global sovereign debt issuance. The Bank of Canada Deputy Governor Tony Grabel says despite risks, banks are positioned to support the economy in a downturn.
The main concern for both households and businesses is a geopolitical or economic shock that leads to a deep recession and a sharp rise in unemployment. Canada's large banks have become more resilient over the past year, with higher profitability and healthy capital buffers. They have also set aside additional funds to absorb potential loan losses. This positions them to support the economy and financial system even in a severe downturn.
TD Bank posted second quarter earnings that beat analysts' expectations. The bank pointed to improving momentum in its U.S. operations. Total net income reached over $4 billion. The bank also increased its quarterly dividend. TD highlighted progress in strengthening its anti-money laundering controls following some regulatory scrutiny in the U.S. There are several reports Iran and the U.S. have reached an agreement on a truce. It calls for a 60-day extension of the ceasefire and for negotiations to start on Iran's nuclear program. The U.S. president still needs to approve the term. The deal comes after the U.S. carried out airstrikes on an Iranian military site overnight. The TSX today up 93 points, or about 0.25% to 34,505 right now. And across the border, you have the S&P up 40 points, or about 0.5%. The Dow Jones in the red by 40 points today. And the Nasdaq up 0.9%, 233 points so far on the day.
At a time of a global energy crisis, Canada provides the United States with reliable power, with critical minerals that help fuel American growth. 99% of U.S. natural gas imports, 85% of electricity imports, 60% of crude oil imports. That is mutual strength. Let's be absolutely clear. Canada Strong will help make America great again.
All right, the Prime Minister, of course, today he's in New York, addressing industry leaders and financiers about the need for a renewed partnership between Canada and the U.S. Let's go to Andrew DeCapua. He's principal economist at the Canadian Chamber of Commerce. Thanks for joining us today.
Hey, Marilla, good to be here.
So the relationship between Canada and the U.S. has been, we'll say, uncomfortable for the last year plus. The Prime Minister is calling for a new partnership, but what could that look like?
Well, I mean, if you took a look at the remarks or listened to the remarks, Marilla, I think the Prime Minister was trying to project confidence. There were a number of audiences that the Prime Minister was speaking to. New York is a global financial hub, right? And so I think the Prime Minister was speaking, to Americans, of course, being an American audience, to Canadians and to the world, trying to project confidence that Canada is on the right track, that we are seeing a lot of momentum in terms of major projects, being approved. We've seen record FDIs in the last quarter of last year. We're seeing some positive momentum, and so the Prime Minister is trying to project that confidence to global investors to say Canada is the place to invest. I think in terms of, with respect to the United States, he's also flipping the coin a little bit. We often say that when the United States succeeds, Canada succeeds, right? But he sort of flipped the script on that and said, listen, when Canada succeeds, the United States succeeds. We have what you need. And so you have an interest in making sure that we are successful.
So the way he spoke of it today was that Canada reducing dependence on the U.S. will actually benefit Americans. What did you think of that argument, similar to what you were saying?
Yeah, well, if we use the investor analogy, right, you don't want to put all your eggs in one basket, right? We naturally have a very intertwined relationship with the United States. The United States invests a lot in Canada. Canadians and Canadian companies invest a lot more into the United States. But it is in the best interest for the United States that we diversify, that we increase revenue sources to different parts of around the world, because that buffers the Canadian economy from any one shock, right? So just like a portfolio, you want to have different sectors, different companies. You can set different weights to different parts of the world. That is what the Prime Minister is trying to say. The rhetoric has been quite strong from the Prime Minister, right, in terms of the nature of the relationship has changed. But I think it's also just restating that, that the Canadian government and that Canada as a whole is taking is on a different path, is on a different mission. And one of those missions, of course, is to strengthen defense, is to meet our NATO targets. That sends a very strong signal to the world that we know that the world is a more dangerous place. We want to step up to that challenge. We also know that we need to become a more resilient economy. We have to attract investment to power our economy, to improve productivity, to grow living standards for Canadians. So we are taking measures to move that forward and make that happen. So these are all projections of confidence, and of course, speaking to a very familiar crowd in New York.
The U.S., of course, moving forward on its review of the trade deal with Mexico, but with Canada not so much dragging its feet, I would say. Do you take this as a sign of a more difficult negotiation to come?
Well, I think it depends on how you look at it. The United States has a number of grievances with Mexico in particular. And so them, whether you want to call it advanced discussions or not, there are a few more kinks to work out between the United States and Mexico than, let's say, the United States and Canada. And so, of course, the conversation has been ongoing and will potentially ramp up in the summer, of course, as we meet that milestone of July 1st. And so I think the Prime Minister used this speech as an opportunity just to remind the Americans, listen, we're here, we're engaged. And it's it's a good thing, because if you're out of sight, you're out of mind. And I don't think that we want to project to the American public, to the American business community, or the American officials that, we're out off trotting the world, trying, and turning our backs to the United States. We're showing up, we're on the ground, and we want to do business. And that's what I got from the speech, and I think that's the general message from the Prime Minister.
We know there are going to be many irritants when that negotiation or that review does get underway. How much of a problem do you think Canada's agreement with China will be for the U.S.?
Well, the U.S. and China are two global superpowers that are trying to battle it out, right? The competition around AI is only making that worse. We're seeing export controls. I mean, and a bunch of different things there. The President Trump was in China recently and brought a bunch of American business leaders there. So they're trying to work through their differences there. I mean, we'll see what happens in terms of how that relationship evolves. But it does put Canada in a very tricky position when it comes to dealing with China, because, of course, the United States is going to want more cooperation. They're going to want more alignment on regulations when it comes to China, and they're going to want more alignment on tariffs when it comes to China. You saw that, of course, come up in the case of EVs, and of course, that as a sticking point for the United States because they don't want Canada to, of course, embolden, China's access into Canada or in the U.S. market on that front. So it's a competitive world, and I think as we sort of become a global player and we face this increased competition, right, we're going to have to wake up to that reality, and we're going to have to face criticism and decide which way we want to go. And I think that's why this diversification strategy is important, because it means that, listen, we've got a lot of stakeholders at the table, and we've got to work with a lot of different countries that maybe won't agree on all the same things.
All right, Andrew, I do have to leave it there. Appreciate your time. Andrew's principal economist at the Canadian Chamber of Commerce. Up next, power sports equipment maker BRP cuts its full-year profit and outlook because of American tariffs. Back in a moment. BRP posted weaker first quarter earnings. Revenues are up nearly 30%, but BRP expects U.S. tariffs to weigh on its performance and has cut its profit outlook for the year. For more on their numbers, we spoke with Jonathan Goldman, analyst at Scotiabank.
If we just rewind, a bit, what happened is, I guess 6 weeks ago at this point, BRP withdrew their guidance from the year. They suspended guidance, and that was because of the change to S232 tariffs. Previously the company was only paying tariffs on the content of the steel and aluminum in their units, and then all of a sudden overnight they were subject to pay the 25% tariff on everything. So they withdrew guidance, and at the time, about 6 weeks ago, they said it would be a $500 million hit to EBITDA. Today, and to their credit, they reinstated guidance, and they've cut that bill down to only about $300 million. So probably better than feared, probably better than anyone expected, if they expected anything. Pretty impressive what they did so far.
Do we know why the change, that drop? What is that, a 40% drop? Or about a 40% drop, I guess?
Exactly. So the original hit was a 40% drop to earnings. They've cut that down to only a 25% hit to their earnings. A bunch of different factors. One, the industry has been better than they thought it would be. The seasonal demand for snowmobiles has been stronger. There was a better promotional environment than they anticipated. The other off-road products are doing well. But the other piece that's truly remarkable is they found an incremental $200 million of cost savings and other initiatives in the business. This is overhead reductions, nominally raising prices by less than 1-2%, and some other efficiencies to offset that tariff bill. So pretty amazing that you could just look around in 6 weeks and find $200 million of savings to offset that bill. So the management team, the entire business definitely deserves a lot of credit here.
Now, does that seem extreme, or does that tell you that maybe the company wasn't running as tight as it should?
Drastic times call for drastic measures. What's amazing is they took these actions and they haven't impacted the long-term profitability or outlook for the business. BRP is a diligent, well-run business management team. They're always looking at innovation. So they haven't cut any costs or corners here that would impair the long-term fundamentals. I think they squeezed out everything they possibly could, maybe delaying some in-house projects or development, looking for ways to save here. But I don't think it was run any tighter than it should have been. It's just, drastic times, people will find whatever they can do to kind of find some savings there.
Okay, and CUSMA, that's been the center point for them. The negotiations are coming up. What are they expecting? What are they bracing for? Or they kind of have two paths laid out for themselves?
It's the billion-dollar question. Originally it was just USMCA, right? And then we have this separate section piece called S232. So on the earnings call today, the company said that, their going-in assumption is we'll see a convergence between those two pieces of legislation and trade policy, meaning, if there's some sort of resolution on USMCA and we restore, what actually is supposed to be a free trade agreement, we could see the same thing sort of resolve itself on S232. So I think any sort of negotiations, any sort of talk, that's the next catalyst for the company, for the stock. Obviously, it would help visibility. I think all parties, on all sides of the border and the three countries are looking for some resolution. I think everyone has come to the realization, lack of free trade doesn't help anybody. Sure, there's always things that can be improved, and we could repurpose manufacturing and, and protect some industries. But I think everyone understands that it's to everyone's benefit to come to some sort of agreement.
And are you surprised at the increase in sales? I mean, we've talked about a lot of people seem to be struggling, but then we see this from essentially, in many ways, recreational vehicles. Or were they stronger commercial sales for them?
That's a really good question, right? So you hit the nail on the head, right? The economy is not great. It's not like people are running. You see the consumer confidence numbers to go out and buy things. So I guess that was surprising. On the demand has been more resilient than we expected. Part of that is seasonal, really strong snowmobile season. The other piece to it, and you probably know this as well, is DEW skews more recreational than utility or commercial vehicles. So what's surprising here, or I guess maybe we should have known, is DEW's products tend to target a wealthier household, a more affluent household, and they've been holding in relatively well. I mean, I think I've heard from one corporate that you're going to need gas prices to go much higher than $4 a gallon before people stop buying $800,000 units, second cars effectively. So that's kind of been the story here. High quality units, performance-based, wealthy households, and they've been resilient, and they've been buying these new products, which have been actually really well received, the new models they've released.
They have an $800,000 recreational vehicle?
Not that much, I think it could go up to 100, maybe 120, okay. Not that high. It used to be in the boats, but they tend to be in the $35,000 range and all the way down. Yeah.
And so you have it at $80. What did I do? Yeah, $80 for the stock. Where any changes on that, or are you still solid on that?
We're still reviewing our estimates. What I would say is what the results do today is they add more clarity to the story. If you looked at consensus going in, I think the range of estimates were anything from 700 million of EBITDA all the way to 1,200. So wide range. No one knew what to expect. What this does is it really solidifies the bill, at least at this point. Obviously, things can change depending on what social media comes out. But at least now we have something to set a peg to, and we can kind of forecast earnings. And, any time when you have more visibility and more certainty on forecasting earnings and free cash flows, it has positive implications for the stock and valuation, which investors prize.
Jonathan Goldman is an analyst, Diversified Industrials, Scotiabank. Up next, the Bank of Canada released its annual financial stability report. We'll look at what the stressors are on the Canadian economy when we come back. We've got an update from the Bank of Canada today. It issued its financial stability report, and in it, the bank outlined what it sees as key risks to the Canadian economy. Let's go through them with Warren Lovely, National Bank Financial. Thanks for joining us today.
Yeah, my pleasure.
There are 3 areas of risk outlined, but the concern seems to be if more than one of them hits at a time. So what could that look like? Can you give me an example?
Yeah, well, so firstly on this risk assessment, some of these risks are familiar, some are newer, but yet very topical for viewers. The familiar risk is U.S. trade policy uncertainty, and viewers just heard about how trade uncertainty is impacting, well-known companies. Most people understand this is a pretty serious risk for the Canadian economy, has been really since about a year ago. So that one's not necessarily new. More recent, more topical, of course, is the war in the Middle East and the potential for financial market volatility there. And then another risk factor the Bank of Canada is flagging here is a disruption from AI, which is, again, something I think everyone's trying to get their head around. So these risk factors have been identified. I think, Morella, to your point, the concern is that you could have some of these dominoes fall one after the other, or sort of have this collection of risks occur at the same time, which could be more damaging for financial markets and the financial system.
Okay, so with the markets on a run lately, valuations are also raised here as something to watch. Do you agree that's a concern?
Well, look, this is a risk assessment, and if an upside risk materializes, that's a bonus. That's maybe gravy. But what the Bank of Canada, I think, rightly needs to do is focus on downside risks. What if things go badly? And I think when you look at equity valuations, credit market valuations, it's pretty clear valuations are lofty, elevated, stretched. So that is a concern. We don't have cheap assets. We've got expensive risk assets. And then again, the other thing the bank is very clearly warning us about is that, look, the geopolitical backdrop Canada's relationship with the U.S., the situation in the Middle East is super fluid, very fluid, hard to assess how long, the Middle East conflict's going to go, how it's going to play out. And of course, we've still got this not so subtle issue of a Canada-U.S. trade agreement to get through. And there's a whole host of associated risks, economic and financial, associated with those geopolitical hotspots.
So one of the last big warnings from the bank in previous years was about mortgage renewals. Are we mostly past those concerns now?
Yeah, we're working through that. And I think, Marilla, that's a good point you raise. I mean, and to the bank's credit, I think they acknowledged something that most Canadians hopefully feel, and that is that our economy has actually proven resilient. Our financial system, our banks, have proven extremely resilient, and households are holding up. And, look, no one is going to say that the mortgage refinancing process has been easy for everyone. It's been tough for many. But the good news there is that we are working through this. There's still some to come. And anyone renewing a mortgage in the next 12 months here will probably see a payment increase, or they might need to extend their amortization and kind of rationalize things. So that won't necessarily be easy, but we've chopped a lot of wood on that mortgage refinancing file. And I think the other thing I'd emphasize is that when it comes to the banking sector, just look at the recent results we just got from the 6 big Canadian banks. That also speaks to the resiliency of the financial system and the household sector more generally.
Okay, let's talk about hedge funds, which was also brought up in the note by the Bank of Canada. Can you sort of expand on what that concern looks like?
Yeah, so again, this isn't a new feature, but it's still raised and identified as a risk factor. And simply put, what's happening here is that governments have got to borrow, and they borrow to finance deficits and investments. So they go out in the market, they're raising money. Increasingly, we've been selling that government debt to leveraged players, hedge funds, and that sounds like a scary concept. And what the Bank of Canada is really trying to say is that, look, those investors, their presence in the market is big. It's quite elevated. They might, be 40% of the Government of Canada bond market in terms of their activity. And if things went badly, if all of those investors, those hedge funds, needed to exit at the same time, in the same way, that could be dislocative. And of course, that is a risk. But I think from our perspective, hedge funds have played a pretty important role here, absorbing bond supply, financing governments, and are actually providing normal course liquidity. So of course there are risks there, but there's also some benefits from having a pretty active investor base in the Government of Canada bond market.
So Warren, the last thing I want to talk about is AI, which, as you mentioned, was also raised by the Bank of Canada today as something to watch, because it could go so many ways, right? We're looking at efficiencies that could be gained by business. We know banks are already beginning to use AI to get some value out of that. We heard one of the banks talking about that today. So what do you see as the overreaching risk for AI?
Well, I think one of the risks the Bank of Canada is pointing quite clearly to is the potential for cybersecurity concerns and the need to perhaps set aside more money to secure systems, financial systems, against AI supported threats. So there's that aspect of AI, the cybersecurity issue. The other risk that the Bank of Canada is mentioning is that, look, the financial system is global in nature. In a lot of cases, you've got systems that the financial system kind of relies on, kind of centralized points or service providers. And if one of those got attacked by AI and brought down, that could have, again, cascading, wider reaching impacts. So there's a few risk factors there. Of course, on the flip side, Morella, as you point out, is the hopeful aspect of this, and that is that, this AI revolution could bring about big productivity gains and maybe drive growth longer term. We certainly know that firms are rushing to invest pretty aggressively, either to benefit from them or protect against AI.
Yeah, AI provisions is where we're going, I guess. All right, Warren Lovely, appreciate you joining us. Thanks for your time.
Thank you.
The Big Six banks, as you heard, beat earnings expectations. We'll dive into what it means for the health of the Canadian economy when we come back. Here are the stories we are following in the newsroom today. EQ Bank shares are trading higher today, despite posting lower than expected revenue and profit for its second quarter. Analysts are noting the lender's earnings for the quarter, as well as cost controls, showed improving efficiency that offset headwinds. The bank's also in the process of acquiring PC Financial from Loblaw. EQB CEO says business will shift once they close the deal. EQB also raised its dividend. IBM shares moving higher today. The company's planning to invest $10 billion U.S. in quantum computing over the next 5 years. The Trump administration announced it's going to invest $2 billion in 9 quantum computing firms. And IBM will receive half of those funds to build the first dedicated quantum chip manufacturing facility in the U.S. Dollar Tree shares are up almost 17% today after the company beat profit expectations in its latest quarter. Comparable sales rose by 3.5% as the discount chain is offering higher priced items in an effort to attract a wealthier clientele. The company is also raising its full-year profit forecast. Here is where we are on the markets right now, with the TSX up about 0.4% over 131 points so far on the day. Across the border, markets are also in the green. The S&P 500 gaining 0.6% and is set for another record close. The Dow Jones is up 20 points. The Nasdaq set for another record close. It's up almost a full percent, or 251 points today. The big 6 Canadian banks beat earnings expectations this week, most raising dividends. So what does it tell us about the health of the Canadian economy? We sat down with Jillian Stovall-Rivers on this. She's with CI Ascent Wealth Management.
There's really 2 stories going on here. The first is obviously banks beating expectations, able to raise their dividends on large, and that signals to the asset owners that everything is well and good. But at the same time, a lot of these banks, if not all of them, have higher capital reserves in place just in case something should happen, just in case we reach that point when maybe some of those mortgage resets happen at a time when interest rates maybe have to go the other way because of inflation concerns. And that's a signal about those loan loss provisions that's a little bit darker than maybe those higher dividend payouts might signal.
Yeah, and we know when that's been coming for a little bit. The banks, I think, have known too, as they've been keeping, putting that money aside too as well. CIBC not increasing its dividend, is that a concern at all for any investors, at least at this point?
I don't think so.
Okay.
I think you could go either way, and I think that the potential for them to increase their dividend going forward still exists. The bigger issue is this 2-pronged economy where you have the asset owners benefiting from dividends, but then you have the people who aren't yet asset owners who are at risk of suffering because of increase in interest rates, increase in cost of energy, all of those things hitting at exactly the same time. And it's nice to see that the banks are prepared to take care of the asset owners as well as the people who are their biggest lender or biggest borrowers.
Yeah, and I think it's, you talk about that K-shape, and it really has been the concern here and where we are going as well. When we talk about that allocation for debt too, are some of them have cut? Did I see that too? At least have we seen RBC maybe cutting some of that, like the little bit of cash that we had, or not?
I don't think so.
Okay.
I think we still need to have those in place. And the increases over the reserve requirements aren't significant, but they're enough to suggest that we might need to do some workouts at some point. And I'm hoping that that is the case, that we find a way to use the banking system in order to increase the financial literacy, in order to allow people to stay in their homes. At the end of the day, what we'd really like to be is a nation of asset owners. Mm-hmm. And the home is really the number one way in which most Canadians can own a home. If that gets taken away from them because of a lack of a workout provision by those banks, then unfortunately we're stepping backwards instead of forwards.
And then ultimately, too, and along that same line, bigger picture here, Canadian economy, just in general, to what the bank's profits and what we're seeing from the earnings for the last couple of days, what it speaks to where the economy is at. What are your thoughts?
Well, I mean, the biggest risk right now that is unknowable is this, as you mentioned earlier, the war in Iran. If we are able to scale that back and we are able to find a way to bring energy prices back down, then we are in a place where maybe inflation doesn't take such a foothold, because that's already driving a lot of decision making for scarcity mindset homeowners, scarcity mindset Canadians who might not have anything more than 30 days ahead of them that they can see. And that scarcity mindset tends to breed poor financial decisions. If we can extend that out by reducing that cause of inflation with the price of energy, then we give Canadians a better shot at building wealth, and we give Canadians a better shot at existing in an environment of hopefully moderate interest rates instead of higher interest rates. Yeah,
and hopefully some good news today, too. We'll see. We've had the back and forth continually on what's going to happen with the conflict in the Middle East, too, but reports that a possible truce has been reached. I'm curious, and maybe just pivoting just a little bit about Mark Carney and the Prime Minister, too, as well. Mm-hmm. We have seen his pitches across globally, too, now in New York with it when it comes to Americans, and we have this CUSMA review looming.
Yes.
It's not a hard deadline on July 1st. We get it, but it certainly seems as Mexico is starting official and negotiations today with the United States, Canada lagging behind, but Canada also, I think, playing a little bit more hardball right now, and that Mark Carney is not just going to give anything up or be there. So what does his message today indicate to you for where the government might be at in continuing to look for this investment from south of the border that is not necessarily trade related, and the benefits that Canada has seen, at least so far, in diversifying the trade that's happening globally?
Today is a good example of something can be brilliant and scary at the same time. I think it is a brilliant move to be down there and telling these stories and opening these dialogues with private investors. And if there's something that private investors love, is really two things. They love lots of things, but smart money loves growth and profit. Smart money also loves predictability and security. And I think that message of being this moderate power anchor in the world that is open for business to be able to bring private wealth and private investment into Canada in order to take advantage of our resource sector at a time when not only the energy, but also all of our minerals, as well as our resources related to the AI build out, are extremely valuable. And if we can be a face and voice of that to the world and represent ourselves as open for business, that's a whole other angle on those trade negotiations that's extremely powerful.
And it's funny that you mentioned that, too, because it feels like the benefits and the offshoot benefits of that. Yes, we talked about the consumers and how they're feeling the pain right now, too.
Yes.
But you look at the other end of that spectrum, too, as well, and the money that this country is making now, too, as a result of the higher energy prices, too, when it comes to the oil and gas companies and that we're seeing. And you talk about the AI build-out that is slowly starting, just the amount of investment, the potential and the capability is there.
Yes. And I bet you nobody comes on the show and talks about Charles Dickens, but this is very Tale of Two Cities, right?
Yeah.
This is very Tale of Two Cities. And I think the objective here would be to try and democratize the ownership and the benefit from those investments in a way that a Canada Strong Fund can make it so that all Canadians can become asset owners in some way, because fundamentally our brains operate differently when we're in a position of asset ownership instead of being beholden to the asset owner.
Jillian Stovall-Rivers, Senior Wealth Advisor at CI Asante Wealth Management. Coming up, sticking with the banks, we'll hear what the banks need to do to justify their rising valuations. That's after the break. All of the big six Canadian banks have delivered quarterly beats this week. My next guest says bank stocks are trading at historical premiums. Are investors ignoring headwinds here? Let's go to Ibrahim Poonawala. He's Senior North American Banks Analyst at BofA Securities. Thanks for joining us today.
Thanks for having me.
How would you value the Canadian bank stocks after latest results?
So I think if we could take a step back and coming into the Canadian results, so 2 days ago, the group is trading at a historic premium, a wide premium relative to historical averages. If you think about 16 times this year's earnings, 14 to 15 times next year's earnings, compared to about 11 to 12 times, right? So we are coming in trading at significant valuation premiums to anything that we've seen. And that more or less, you had a couple of stocks that sold off a little bit today and one yesterday. But in general, those multiples are holding on back of what were, we would say, in line to slightly better 2Q results.
Okay, so obviously, yes, they had a lot to report. They've done well, but we know that there are some concerns on the horizon, and some of the CEOs did mention those in their calls either yesterday or today. The economy is sort of anemic, right? And right now, those fears seem to be pushed out of the way. But do you think that the bank's earnings can continue to grow given the climate?
So that's a great point. And you used the word anemic. What we've described is the Canadian economy, in our view, has been more recession-like over the last 12 to 24 months. appreciating different provinces are doing a little bit better versus worse. But overall, when you look at the unemployment, you look at the impact from once interest rates moved higher to the housing market, right? And then you had the hit from the tariff uncertainties about 12 months ago. So the economy in the year and now is generally struggling. And what you're hoping is the combination of some of the pro-business policies from the Carney administration begins to kick in by this time next year and drives what is hopefully a multi-year investment cycle in Canada. And then reaching some sort of a resolution with the United States on the trade negotiations, which is manageable. It's probably going to be negative in certain respects when we think about certain industries. But if net the outcome is not materially worse than what's already been discounted or expected, that's kind of where we are, where the CEO of RBC, Dave Mackay, I think framed it well. It's resilient in the near term in terms of the Canadian consumer. And then there's a lot of optimism around what long-term could look like given the investment plans that are out there and being discussed actively every day.
Yeah, the trade deal is definitely the more uncertain there as opposed to the infrastructure build-out. The banks have taken different routes to get to their earnings beat in the last 48 hours. For some, it's trading revenue, right, with all the markets being as high as they are and there being uncertainty there. Some of them have lower loss provisions, so they're expecting fewer defaults. Which metric, when you look at them, is the strongest when comparing?
So you're right. I think what's been the story for the last 18 months, there are three drivers of earnings growth and more or less kind of played out even this quarter. One is capital markets. You're seeing strong capital markets momentum. We've been very bullish on the theme, including in the US with some of the US big Wall Street banks. And that continues to help the banks when we think about trading, investment banking. So that's point number one, is what's driving earnings growth and EPS beats capital markets. It's also happening in a time where the banks have a lot of excess capital. So you have share buybacks that have kind of underpinned some level of EPS support, valuation support for the stocks, where the banks have a lot of excess capital, they generate a lot of capital, and they're deploying that towards buybacks as opposed to historically used to be M&A as an option for inorganic growth for the banks. So those two drivers continue to support earnings. Margin expansion, we are probably in the late innings of the margin expansion cycle. If you think about it, maybe there's another 3 to 4 quarters to go. But what's really not kicked in is where you're seeing pressure is domestic growth, be it mortgage growth, commercial growth. It's still a bit anemic, again, reflective of an economy that is still trying to recover from the rate shock, from the tariff shock over the last couple of years. And so it's a mixed bag. And I think the big question is over the next 12 to 18 months, can we see this handoff from margin expansion, capital markets driven growth to more Main Street growth? So think about mortgages coming back, commercial lending picking up, domestic capex activity picking up. And that's what investors are counting on.
Okay, so let's go a little bit farther into that, because you talked about the oil price surge. Of course, that is affecting your average Canadian trying to fill up, to go back and forth to work, that kind of thing. It's likely to affect more down the road. There are definite pressures on the finances of Canadians. So how big of a threat is that to the big banks?
So it is a huge risk, right? So I think the upshot is Canada is a resource-rich economy, and higher oil prices are seen as a positive for the Canadian economy. But as you very well know, it's not true for Canada across the board. Yeah, there certain provinces will do better, but places like Ontario, where you're already feeling the burden of the US tariffs, and then you have the higher oil prices, it is a negative. And I think to us, the single biggest risk from here is if sustained higher oil prices lead to higher interest rates, and then that continues to remain a pressure point when we think about mortgage refinancing, credit card debt, etc. So higher interest rates on the back of oil prices, like we are very worried about that. And I see that as the single biggest risk that could derail some of the momentum in terms of the outlook for the stocks and earnings growth.
Ibrahim, I got to leave it there, but appreciate you joining us. Ibrahim Poonawalla there, a senior North American banks analyst, BofA Securities. Coming up, Canada is on the cusp of a major wave of investment in energy and infrastructure by Ottawa. We'll find out what it could mean for the future when we come back. Canada is about to see a huge wave of investment across the country, across the economy, from energy to infrastructure. But the question is, will that money help build a cleaner, more resilient economy or lock in longer-term risks? To find out, we spoke with Elliot Capel, National Climate Change Leader at PwC Canada.
As you noted, we'll be investing billions, if not trillions of dollars into housing, infrastructure, and defense. And the way we do that is consequential. Will houses be resilient to the impacts of wildfires or flooding? Will infrastructure set us on a path towards net zero at 2050, or will it push that path further out?
And I mean, with that, what are the things that will push us towards that, and what are some of the things that maybe will have us hesitate? I'm guessing money is one for hesitating, but what are some of the things that will say we need to do this? It makes sense.
Yeah, well, absolutely, we need to address the physical impacts of climate change and infrastructure. That is, of course, for our own business case, because the physical impacts could impact operations and maintenance, useful service life, or other physical impacts, but also to make us competitive in attracting that investment globally.
And are you worried? I mean, south of the border, we had the president say, drill, baby, drill. Energy with everything that's unfolding in the Middle East. Oil here is obviously has garnered renewed interest. Are you worried that's going to overshadow any push towards more greener, cleaner energy sources?
Well, so far it hasn't. It's been more of an all of the above sort of answer to the question. We're seeing record investment in solar, wind, renewables, batteries, and as the cost and availability, as the cost comes down and the availability goes up of those alternatives, we're going to see again more of an all of the above sort of approach to energy.
And what will keep driving that? I mean, if we see oil prices drop back down to say $70 a barrel, will that interest be lost, or does it feel like there's the commitment there for those fields?
I think there's a need for an all-of-the-above approach. When we look at the energy demand, and the government underlined this last week when they released the electricity strategy to double the availability of electricity. Well, that's going to have to come from a variety of different sources, which include, of course, traditional energy sources, but renewables, batteries, nuclear, solar, and hydro.
And where is Canada in all this? I mean, nuclear, I imagine we sit near the front, but how about other energy sources? How are we doing?
Well, Canada is definitely a global player in energy. You noted nuclear. We have some of the world's leading investments in the Canadian nuclear sector, but also in hydro, and then some of the largest investors in energy globally are based here in Canada.
And one of the things you say is that we're moving beyond disclosure. So what does that actually look like in practice for investors when you say we're moving beyond disclosure?
Well, sustainable finance in the last, let's say, decade was really focused on like labeling. So are the goods and products and services that you're going to buy sustainable or ethically sourced? And if you walk the halls of the grocery store, you see the impact of that. What we're shifting is from a consumer markets focus to questions that are fundamental about the architecture of the Canadian economy.
And with that, is the money coming? Is the money following this?
Absolutely. You see record inflows of sustainable finance in various areas, but it's not all a good news story, right? There's a lot of change right now. We're definitely at a consequential moment for sustainable finance in Canada and globally.
And what do we need? Where are we falling short? Like, what do we need to change to try and draw more money in and continue this drive?
Well, absolutely. We need to, as I said before, assess the physical impact of climate change on our investments. But there are also questions around, for example, a Canadian taxonomy, which is live at the moment, so that we can say what we mean when we say something is green or when we say something isn't green, what falls in which bucket. We need to make that very clear for investors and indeed for consumers as well.
And it comes back to the money thing I mentioned about it's cheaper to get oil out of the ground right now. Is it becoming cheaper to find alternate sources of energy and use alternate sources of energy so that it will draw more people in?
Absolutely. When you see the cost curves for just about any technology, they go, down and to the right over time. And that isn't specific only to energy, by the way. It's to a number of other aspects of this conversation. So, for example, when we think about making infrastructure or homes more resilient to the impact of climate change, we see many more solutions out there in the market. And we see that also for the availability of something like even as simple as a heat pump in your home by comparison to a traditional furnace.
And what's the better way to drive this? We tried government regulation. We're now going a little more towards free market. Is there one way or the other that's better, or a combination?
I mean, ultimately, the market is going to flow capital to safer, long-term, resilient bets. And so I think the role of government is to create the conditions for that capital to flow properly and for Canada to compete for the capital that aligns to our long-term growth and to our values.
And does it feel like the country's starting to do that now when it comes to cleaner?
I have to say, when we hear from our clients and what we're seeing in the market, there does seem to be a consensus forming around the need to create those conditions. But back to what I said earlier, we're definitely it feels like we're at the precipice of a moment. Sustainable finance is at a crossroads where it's moving from that labeling regime that I talked about earlier to something that's simply higher order and fundamental, and that's a big moment.
Elliot Capel is National Climate Change Leader, PwC Canada. Last look at the markets before the end of the trading day, with the TSX up right now about 1/3%, 111 move point on the day. And south of the border, markets are in the green, with the S&P up about 0.5% and set for a new record close today. So up 42 points so far. The Dow Jones up 24 points, so not a big move for the Dow. And then the Nasdaq up 0.9%. And again, it is set for another new record close, beating only yesterday's record close. That's a 231-point move. Back in a moment. Here are the closing bells for the end of the trading day at the Nasdaq. Sale GFP ringing the closing bell, and in New York, it's Churchill Asset Management. For Toronto's ETF Express Canadian Awards ending the day. You're watching the close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. The TSX Composite gaining 105 points today, ending the day at 34,517, so up about 1/3%. A new record close for the S&P 500. It's up 43 points today, or 0.6%, beating the record close of just yesterday. The Nasdaq had also a new record close today. It's up 242 points, or 0.9%, taking the end of day number to 26,917. Let's get to the movers in Toronto today. We're going to start with ATS Core, which is down over 14% today. That's a $6.99 drop, and taking the price to 42. Moving to CIBC today, it is down over 5%, or $8.58, taking the share price to $150.96. It did report earnings today. Let's go to the flip side with Curaleaf Holdings, a cannabis company, up today more than 11%. They are looking to try and grow their business in the U.S. with a reclassification of cannabis. Again, so that stock up 50 cents a day today. Go Easy recovering from private credit concerns, gaining 9.3%, or $3.55, and taking that stock price to $41.70. Tamarack Valley Energy, also a gainer. It's up 6.8%, taking the share price to $12.90. So let's get to some movers south of the border. Bloomberg's Avalon Purnell joins us now with that. Avalon, Eli Lilly pharmaceutical company, shares moving on an announcement today about global drug launches. Tell me about that.
Yes, actually, I will say that the stock was not necessarily moving on that drug launch. It was more so because CVS actually announced that they are going to be allowing their drug to be covered. And for, at least for weight loss drugs, they're going to be now allowing coverage of Zepbound. That is definitely one of the key detractors or reasons why people tend to not get onto weight loss drugs, because they need their insurance to cover it, at least here in the U.S. So now more than 10 million patients could potentially get access to Eli Lilly's drugs, now that CVS is saying that they're going to be allowing that to happen.
All right, big news for them. Obviously, let's get to Snowflake having a good day. Was it their best day ever?
Yes, at least their best day since their IPO in 2020. So definitely a good day for investors there. That's after the software maker had a better than expected first quarter results and also gave a stronger than expected full year guidance. Part of that is also because they had a $6 billion deal that they signed with Amazon to agree that they're going to be using their chips in cloud services as well. And what I found to be really interesting is that one analyst, Evercore, said that one thing that they found very notable is that Snowflake looks like one of the very few clear AI winners in the software space. They've been hammered all throughout the year, but now definitely a good day for investors.
Okay, let's get to Agilent. Tell me about them.
Yes, Agilent is a different name in the space. Actually, one of the biggest jumpers on the S&P 500 today. They jumped about 17% to end its biggest one-day jump since 2002. And that's after having an adjusted earnings per share forecast that was better than expected and also better earnings than expected for the first quarter as well. Worth noting that they actually received an upgrade from Bank of America, who said that despite all of the headwinds and concerns in the broader space, they still seem to be meeting all of those expectations.
All right, Bloomberg's Avalon Purnell with the latest out of the U.S. Thanks for that. And up next, we will take a deeper look at the U.S. market as traders react to the latest developments in the Middle East. We're back in a moment. New record closes again for both the S&P 500 and the NASDAQ today. Let's dig into what's been moving the markets with Scott Wren, he's Senior Global Market Strategist, Wells Fargo Investment Institute. Scott, thanks for joining us today.
Hi.
So where is all the optimism coming from, despite the revision in the U.S. GDP number?
Yeah, I tell you, this has been a pretty good run. Obviously, earnings have a lot to do with it. We might get out of this year with 25% growth rate for earnings this year. The market doesn't seem to be paying a lot of attention to what's going on in the Strait and in the Gulf. Clearly, that could become a problem because there's certainly some risks there. But I think, from our perspective, we felt like, is this Iran situation going to be of a somewhat limited duration? We thought it would be. It's maybe lasted a little bit longer than what we thought, but clearly the market is not concerned that it's going to be ongoing, that really the price of oil is going to spike a lot higher, because the market's just, I think the market's done better than most people thought this year. It certainly has done better than what we thought.
Yeah, we're seeing smaller reactions to that Iran conflict. Oil still under $100 start of the day. Do you think investors, though, are appreciating what is the longer-term fallout?
I don't think they are, because right now, if you look at whether it's materials or oil, things that come out of the Gulf, there's been a reliance on stored inventories, and so that's not going to last forever. So if this issue goes on and the Strait remains virtually closed for much longer, you're going to start to see some real supply disruptions. And of course, we all know that the U.S. is pretty energy independent, but of course, much of the rest of the world is not. And so whether you look at fertilizer or oil or any number of other products that come largely from the Gulf, or a good portion of the global supply does, those are going to be in short supply. And so I think the market isn't really thinking about that a whole lot right now. But down the road here, if the Strait remains closed, then it's going to become more and more of an issue.
You mentioned earnings, which we know have been quite stellar. We know tech has done really well. Financials keep doing well. But are earnings enough to keep this market rally going?
Well, I tell you, I think right now that it is, but and we're through this reporting season for the most part. But these earnings numbers are going to have to really come through when we start to see second quarter earnings reported. There's not going to be much of a room for error. And that's, whether it's these big tech companies that are obviously doing very well and carrying the market to a large extent, or really just downstream from, the other 493 companies in the S&P 500. So I think we're going to be, this next reporting season for the second quarter earnings, there's really going to be a focus on coming through on earnings. Now, the beat rate's been very good. And if we see what happened last quarter, or really any of the last few quarters, that should be okay. But there's just not going to be much more margin for error. When you see things like the Atlanta Fed GDP number for the second quarter coming in north of 4%. I mean, that's a surprising number to me. That particular indicator, I don't have a lot of faith in terms of the absolute number. I have some faith in the direction of it. And we do think the economy is going to improve as we move through the year, and particularly in 2027. But there's lots of opportunity for earnings. This CapEx related to AI is just, spectacular. We see over, $800 billion just from a handful of the big guys. So I think it's there. It's starting to trickle down through the rest of the economy. Consumers are still spending. They're employed. The unemployment rate is low. So I think things are set up. But as I said, there's not a lot of margin for error on any of these things for the market to, if it wants to keep going higher.
Of course, the U.S. Economy relies very much on the consumer, and we know sentiment is low for consumers. What are you seeing in harder numbers?
Well, I think the sentiment numbers, if you look at the University of Michigan, for instance, the market's not even paying any attention to that indicator, which, historically it has been bad. But, there's been some question over, who they're surveying, how it's surveyed, those kinds of things. But I think, if you look at consumer confidence, these numbers have dipped down. And historically, consumers, they do have low confidence when gasoline prices are high. And as I, remind myself all the time, U.S. consumers, what they say and what they do are often two different things, certainly at a couple of different points in the cycle. But if they're employed and they have money in their pocket, they're going to be out spending it. If you bet against that, that's a low probability outcome. I mean, if we have low unemployment and consumers have money in their pocket, they're going to go spend it. And that's been, that's kept the economy rolling along with this AI CapEx spending. And those are the two gigantic factors that we really, need to focus on going ahead.
All right. So tech and energy, the obvious ones here, but you think investors should add to utilities and industrials. Can you explain your theory behind that?
Sure. Technology, we like technology. We've been back and forth a little bit over the last maybe 2 years on that, because as valuations have run up, we've maybe lightened up. And then as tech fell, as it did relative to the rest of the market, not all that long ago, we got more interested. But we've tried to keep an AI theme. And if you think about industrials and utilities, somebody has to build the data centers. They need bulldozers, track hose, components, all those sorts of things. Our utilities analysts think that over the next 7 to 10 years, that power demand in the U.S. is going to be up at least 25%. I mean, I've heard some of our competitors on the street throw out a 50% number there, which is just a huge increase in demand. I don't know about you, but I don't think utility rates are going to go down. So, utilities are going to be doing very well here off this increased power surge. So, once again, the grid needs to be upgraded. Who's going to do that? Well, once again, track hose, bulldozers, components, all those companies are in the industrial sector. So I think those are two ways to play the AI boom and infrastructure spend that we see. And those are probably sectors that I would think would be fond of for quite a while.
Scott Renning, I'll leave it there with you, sir, but thank you for your time.
Thank you.
So the Prime Minister, Mark Carney, announced Canada will purchase Saab's Global Eye system for Bombardier jets. That will be to boost Arctic surveillance and defense. More from CTV's Judy Trin.
At a crowded defense conference, the Prime Minister announced a joint Swedish-Canadian venture.
Canada has entered into negotiations to procure Saab's airborne early warning and control aircraft.
Saab's Global Eye surveillance system is built on the platform of Bombardier's corporate jet. The company has at least 40 aircraft in its pipeline to be sold to Canada and other allies.
We'll be militarizing it here in Canada, not only for our own needs, but for export.
3,000 jobs could be created. Economic spin-offs are in the tens of billions of dollars.
What this will do is create a new layer of job opportunities in terms of the modifications of the aircraft. So what Bombardier is doing now is getting actively involved in the discussions to create this secondary production.
Saab beat its American competitor for its surveillance aircraft. Momentum that could improve its chances in another jet deal, selling Swedish Gripen fighters to Canada.
We can show now as a company and as a country how closely we want to work with Canada.
At the Lockheed Martin booth, the F-35 simulator and its test pilot attracts interest but not buzz. Amid U.S. trade tensions, moving forward with procuring fighter jets has been paused for more than a year, worrying Canadian suppliers who have much to lose if the F-35 isn't selected.
Direct jobs, but also strengthening the company's programs and capabilities.
Wrapping up the negotiations for these surveillance planes will likely take a few more months. As for a decision on the fighter jets, the federal government is still refusing to say when. Judy Trin, CTV News, Ottawa.
Straight ahead, The Gap will be reporting earnings. We have that when we come back. The Gap has reported first quarter earnings. Here are the numbers as they come into the newsroom. First quarter net sales coming in at $3.5 billion. Now, the estimate had been at $3.52 billion, so a bit of a miss for Gap there. Forward-looking adjusted earnings per share at about $2.3 to $2.4 billion. They saw about, sorry, that is not earnings per share. That is not a number I'm looking at there. Let me look to first quarter gross margin, 40.5%. The estimate had been 40.3%. First quarter Gap global comparable sales are up 10%, and the estimate had been well under that at 5.6%. So they did beat for comparable sales in the world. But Gap is lowering their sales outlook as Old Navy, Banana Republic falter. Let's take a look at what's come in with Zach Warren. He's equity research analyst, CFRA Research. Zach, thanks for joining us today. Is there a key metric here you've been looking for?
Not really. You know, it's impressive the growth that they're seeing at Gap. Obviously, it's their second largest brand. Old Navy is their largest, and Old Navy did about $2 billion in sales in the quarter, but still growing. So they've got all three of those brands growing. They've got Old Navy, Gap, and Banana Republic growing on a comparable basis. And Athleta is the one that seeming to be struggling a little bit. So it'll be interesting to see what they say on the call about Athleta. We'd really like to see that brand stabilize, and it's not. Obviously down double digits in comparable sales in the quarter. I think the number that you were referring to at first was the EPS guidance. They raised that a little bit to $2.30 to $2.40 a share for the full year. So shares are trading around 10 times forward earnings, which we think is pretty attractive.
Okay, yes, thank you for clarifying that number that I was looking at. Let's get to the talk about consumers, because we know they've been dealing with higher inflation, energy, filling up the tank a lot more for that. Do you think there's just less money for consumers, or is this more about the brand itself?
Yeah, I mean, I do think that there is a little bit of struggle on the consumer side. Obviously, elevated gas prices do have an impact. I think that was a little bit offset by, at least in the U.S., by the tax refunds that the U.S. got. So you saw elevated tax refunds, which should offset a little bit of those gas prices. I know some analysts and economists have said that maybe that's running out now, the offset. So it'll be interesting to see in the call and over the next quarter or so how that consumer holds up.
Something we haven't talked about or touched on in a while is tariffs. And we know a lot of these companies take their inventory, get their inventory built or manufactured elsewhere before bringing it to North America or sending to other markets. Are tariffs still an issue for the Gap?
Yes. So, they put out specifically the impact to gross margins, and they say 200 basis points in the quarter was the impact of tariffs. So it's definitely still impacting this company. And Gap has a very large U.S. Revenue share of their total revenue. So it impacts them greater than some of these other companies, which is why you probably see, valuation has come in a little bit, trading at 10 times. It's towards the end of the peer average. A lot of their peers trade around 13 to 14 times. But that's probably one of the reasons. But we think this is a buying opportunity for Gap. They've rolled back the IEEPA tariffs. It'll be interesting to see, if they get repaid for that or how, some companies are coming out and saying that they're already looking for refunds in the second quarter. So it will be interesting to see what happens with tariffs in the U.S. and how they work out.
Yeah, some of the bigger American companies I know are saying they're owed billions of dollars in tariffs repayment. Let's talk about the competitors for Gap. Who are they? How are they doing generally? Is Gap sort of doing about as well as others, or are others sort of hitting it a lot better?
Yeah, so we would say that, Gap is performing, I guess, at a peer average, right? So they're seeing some sales growth than they have over the last few quarters and years. But it's not, at like some of its other competitors. We'd say on average they're about what with peers. You've got Ralph Lauren that's really performing well, and then some of the larger, Lululemon is doing fine. They continue to grow. They've struggled a little bit in the U.S., but their international growth has offset that U.S. stagnant, stable revenue. So. We think Gap is kind of trading around peers, like American Eagle and Abercrombie and Fitch, where you're seeing, low single-digit revenue growth, and they're able to expand margins. I think the story for this company is buybacks. So they've got a really good balance sheet. Another company is Abercrombie and Fitch. Very similar. They have a very strong balance sheet, and they've started to buy back shares because they think their companies are undervalued, and we think so too.
Okay, let me ask you where they have some growth opportunity. If they're looking to change it up, if they're looking to lure back consumers, is it a matter of offering different products? Someone's saying perhaps beauty might be an area they could get into?
We think internationally, right? So a lot of brands are seeing success, especially with the tariff uncertainty. They're really pushing their international segment because it helps insulate them from these U.S. tariffs, right? So if you're able to grow, Europe and Asia 10 to 15%, it helps insulate you from those U.S. tariffs, which is why Gap has really fallen under pressure in recent quarters and years, is because they really have such a large percentage of their total revenues come from strictly the U.S., whereas Ralph Lauren is less than 50%, right? So you've seen the difference between the two shares. Ralph Lauren trades at 21 times earnings. And their stock has been on a tear for 18 to 24 months, and Gap's kind of the opposite, right? So we think international is really important for these companies, especially to help insulate from tariffs.
All right, Zach Waring, I'm going to leave it there. So thanks for joining us today.
Thanks for having me.
Up next, big tech earnings season now wrapped up. We'll discuss the reason data centers are becoming more unpopular in the U.S. Back in a moment. Here are the stories we are following in the newsroom today. The Prime Minister says there's no better ally and predictable partner for the U.S. than Canada. He made the remarks at the Economic Club of New York, where he highlighted the country's role as an influential trade partner. Mark Carney also says partnering with Canada will make America great again.
At a time of a global energy crisis, Canada provides the United States with reliable power, with critical minerals that help fuel American growth. 99% of U.S. natural gas imports, 85% of electricity imports, 60% of crude oil imports. That is mutual strength. Let's be absolutely clear. Canada Strong will help make America great again.
The Bank of Canada says the financial system is functioning well despite American tariffs and uncertainty. It says households and businesses remain in stable condition, adding lenders have strengthened their capacity to absorb financial shocks. The bank warns, however, that a more turbulent global environment poses risks to financial stability, noting the Middle East war has raised uncertainty and market volatility. There are reports that Iran and the U.S. have reached an agreement on a truce extending the ceasefire for 60 days and adding that negotiations will start on Iran's nuclear program. The U.S. president still needs to approve the terms. It comes after the U.S. carried out airstrikes on an Iranian military site overnight. Investors are investing in the build-out of the data centers, but our next guest expects AI data centers to be a heated political topic in the upcoming U.S. midterm elections. Let's go to Gil Luria, Managing Director, Head of Technology Research at D.A. Davidson. Gil, thanks for joining us today.
Thanks for having me.
So, first of all, is the data center expansion progressing as quickly as anticipated?
Oh, it's progressing a lot faster than anticipated. As the economic returns start to pile in for these large companies, they're more eager than ever to build even more data center capacity. That's how we even get into this conversation about data centers in space, is that the rate at which we're building data centers terrestrially isn't enough to satisfy the speed, the demand for AI compute is growing.
Okay, so let's talk about energy and other commodities needed for the build out. What ends up being the biggest bottleneck at this time?
There are several bottlenecks. It starts with municipalities approving the development, then having enough power locally to power the data center, then having enough people to build the data center, the chips. Now, we don't have a shortage of NVIDIA GPUs anymore, but now there's a shortage of CPU and of memory. The equipment to power the data centers is in short supply. And then you get back to the issues that these companies have once they have data centers with those same municipalities that sometimes have buyer's remorse.
Okay, we know we've seen a lot of protests in the U.S., smaller communities who don't want the data centers there. What are the risks you see as putting data centers into some communities?
So at the local level, there's a couple of hazards. One is it's a big draw on electricity. It's a big draw on the water supply. And there's been some reports of noise depending on where the data center is located. So those are the drawbacks. The benefits are that the data center construction creates jobs, and then the data center operations create jobs that are sustainable. And so at the municipality level, that's the trade-off. But then we also have the trade-off at the national level. This is a big drain on a lot of resources at the national level. And some of these AI companies are talking about how their AI models are going to displace jobs. That's not a message that anybody wants to hear. And so at the national level, we're starting to get pushback. Not only are you making these noisy, water, energy hungry facilities, you're also telling us that these very same data centers are going to be why we lose our jobs. That's why you're starting to see so much pushback. You're seeing commencement speakers at universities getting booed off the stage. Okay, so talk to me a little bit more about cost of living, because you're going to have these folks who are coming into work. They might be from out of community. They're going to have to be trained in certain things to do certain functions at these data centers. Are we looking at a situation where the average community member won't be able to afford things in the community anymore? Well, the influx of temporary workers, the installers, the HVAC engineers, the architects, et cetera, those are temporary and fleeting. So those may not impact cost of living quite as much as the fact that the engineers and technicians that operate these data centers are very well paid. And therefore, as they become part of the community, they may bring the cost of housing up, for instance. But it would have to be a very small community for that to be material. It actually doesn't take that many people to operate a data center. Takes a lot more people to build it. Why do you think this is going to become a big issue in the midterms? Again, the pushback we're getting is from two different levels. One, it's the disruption to many people's local municipality, and then it's that threat of jobs. And the last thing you want to do ahead of an election is tell your constituents that they could lose their jobs to artificial intelligence, to machines, to technology. And I would expect some savvy politicians, especially since we have a lot of degrowth politicians in the US, to latch on to this issue and make it a big part of their campaign, especially in the places where data centers have come in and have been disruptive, say Northern Virginia, some parts of Texas, North Dakota, Wisconsin. These are some of the places where data centers have been disruptive, and I would expect some savvy politicians to pick up on that and make it a campaign issue.
Have you noticed a trend when you see the pushback? Is it because there are smaller communities you don't want it? Is it because if they're outside a bigger city, does it tend to be okay? What are you seeing as far as trends to the pushback?
Yeah, the smaller the municipality, the more impact, the more resistance there's going to be at the local level. So rejecting data centers at the local level. The issue of job security is a national issue. In fact, it's a global issue, but it's a national issue in the US where this conversation is starting to ramp up about how this is going to impact the job market. Mind you, we don't have any evidence to conclude that people will lose their jobs to AI. People, at most, what we're seeing is some technology companies reduce their headcount to pay for their AI investments, but that's very different than saying that AI is going to do anybody's job better than they are. But that doesn't mean that the discussion and the threat, especially if you're graduating from college or graduating from high school, the threat of not having the ability to find a job is something that will definitely impact voters come midterms.
Gil Luria, good for you to join us, sir. Thanks for your time.
Thank you.
All right, we're going to take a quick break. We're back in a moment. Stock market bulls in the U.S. may have an unlikely ally to thank for the next leg up, short sellers. Let's go to Bloomberg's managing editor of U.S. stocks, Michael Regan. He joins us on this today. Michael, how much a short interest is there in the market right now?
Yeah, it's really, I guess you could almost just describe it as extreme. One firm, S3 Partners, which analyzes short interest data, noted an uptick of about $100 billion worth of short sales just since the end of April for across the universe of stocks in the U.S. and Canada. And the traders at Goldman Sachs' trading desk looked at it from sort of a different angle. They looked at the median stock in the S&P as far as short interest and found that 3% of market capitalization is been borrowed and sold short. So to put that in perspective, that 100 billion increase since the end of April amounts to $2.13 trillion of short interest in the U.S. and Canadian markets. According to this S3 firm, that's the highest in their data going back to 2010. And when it comes to that 3% of market cap that Goldman pointed at, they say that's the highest since 2011. So really kind of this fascinating dynamic that even as this market has ripped higher since the lows in March, been a lot of skepticism about it and really a lot of short sales being done by people betting that this rally won't last.
Okay, where are they concentrated?
So Goldman pointed out that what they call the unloved sectors. You know, obviously everyone's been very bullish about AI, the chip makers, and the big tech stocks. But the shorts have really congregated on the defensive sectors. Goldman pointing out that short interest in utilities, healthcare, consumer staples stocks are at either at or near record levels. So to them, that is sort of the place to look if you're expecting sort of a massive short cover to come in. And, you know, they call it right tail risk, meaning stocks in those sectors really might bounce significantly if there is sort of the catalyst to emerge to undo all these short selling bets.
Okay, so typically or historically, how does this play out?
So we're already sort of seeing it playing out already. Goldman has a basket of the most shorted stocks in the U.S. It's up more than 8% this week. So when a short cover happens, it basically means that the shorts who have borrowed these shares and sold them short get nervous that they're on the wrong side of the trade, and they rush to buy back the stock to repay their loans to brokers rather quickly. If you look right at the end of March, right when the S&P bottomed, that Goldman short index jumped like 7%. The S&P jumped 3%. So it tends to be a very short but very severe snapback rally when the tide turns and a lot of these short sellers decide to cover their bets.
All right, Michael Regan, going to leave it there. So thanks for your time.
Thank you.
AI-enhanced glasses starting to get more popular. Wearable devices with built-in cameras, microphones, audio and visual displays to help users with things like reading and recognizing faces. Bloomberg spoke with Wang Li, the founder and COO of Even Realities, about the smart glasses sector and how consumers are interacting with the technology.
Our strategy is to build smart glasses that people can actually wear every day. As you already tested out, and also I'm wearing this, we believe the next phase of computing is not start from this very bulky headset, but with lightweight area that fits naturally into the daily life. So for us, the growth comes from the three things: the better hardware for sure, and also more useful AI experience, and also broader distribution. We are focused on products that combine optical clarity, especially for the prescription wears, and also comfort, life, and also discrete design. And also for the business is strong because I think right now people and the consumers are already shifting from the interesting gadget to practical wearables, especially for productivity, like other really practical features, and also real-time information. So that's where we are here, and also we are launching the glasses. The first generation is around like 24 August, and last year we have the second generation. And also right now we are, although still early in the category, but apart from our user website, we already have more than 500 global premium optical shops, including in Hong Kong, including in Singapore, in Japan, in a lot of European countries. So apart from that, we are also grow really quickly in the consumer electronic shops, like the MediaMarkt, Fnac, like Yodobashi in Japan. So I think for us, the interest from consumers and the market is really grow really fast, but we need to do the product in the right way.
Right. It's a newish segment. It's new, but it's not very, very new. And there are lots of players in the market, as you know, Wang Li. So I'm curious, what do you think sets you apart? What's different about your product lineup than what's available in the market?
I think the market right now is like the competition definitely is increasing, but definitely there are, three paths that different companies are going for. The first one definitely is camera glasses, and also definitely Meta is investing by far the most in the market. And also the second category is the display glasses as wear in the market. And third one probably is the hybrid, one that both have the camera and also display together. But I think for us, like the people that are wearing camera glasses, they already arise a lot of concerns about the privacy, about their social isolation kind of thing. So we think that the biggest challenge for all the glasses that are there for the everyday definitely is still the comfort, battery life, privacy, and also optical performance, and also prescription support, and finding use cases that frequently enough to become really habit. So for us, like camera glasses may appeal to some consumers, but they also create privacy concern that I said. Well, the mass majority of tech giants, they are right now focusing on the capturing, which means mounting camera on people's face for filming or for social isolation. They are not only facing, I think, a massive privacy reckoning and also legal lawsuits, but also overdrawing the public's trust. So for us, we believe the glasses in everyday life should be like utility of information, helping people deal with their daily life, daily work. So by removing the redundant cameras and also focus on discrete display and information processing, we don't report the user's past. We only empower their present. So yes, I think competition is increasing, but the category is still wide open because we have different the paths of the roadmap.
the path to the roadmap. It's interesting, right? The real use sort of case for these smart glasses is not about novelty anymore, as you say, Wang Li. I think Google was the one of the latest that unveiled these AI glasses, is saying they're close to an inflection point in this market of mass adoption. Are you starting to see more mass adoption in the space, and what's going to get it there?
Yeah, I think for the mass adoption, first of all, definitely the product it need to be really catering to the consumer's needs in their daily life. But for the needs in the daily life, definitely we do not want the cameras to have like filming the others every day, every time, right? Even though the camera is not turned off or turned on. So I think for the real time assistance because it's a variable, so it can help you with your real time assistance. For that part, definitely we need context, we need AI, we need the teleprompter, translation, navigation kind of real practical features to help consumers to shift their graphic UI UX interaction with your phone, with your laptop to a more conversational-based UI. That is really depending on the development of AI and agentic AI. And also, I think for the mass adoption, definitely apart from the product itself, definitely the prescription service offline, and also the distribution channel offline. For example, the optic channel and also healthcare channel offline will help to because people can actually feel the product, not seeing that from online from other videos, so they can actually feel the product and then buy them if they have the really practical needs. So I think in that case, definitely the channel's ready, and also the product is evolving, right? So we need to evolve it in the right way, not to grow trust. Trust, I think, probably will be the biggest issue since it's a new category and different companies want their different agenda developing all the glasses or all the wearables out there.
All right, coming up, hot picks. We zero in on 3 picks in the biotech sector in a moment. Time for hot picks, and we looked at 3 picks in biotech. We got more from Laura Chico. She's Managing Director, Senior Biotechnology Analyst at Wedbush.
One thing that might surprise the viewers, you mentioned the XBI biotech ETF is slightly ahead of the S&P 500. I think it's particularly notable because the biotech has been out of favor with generalist investors for a number of years. But overall, I think sector drivers are really flashing green lights. We're seeing a convergence of attractive valuations. M&A is back for biotech. And a lot of these companies are now embedding de-risking strategies in their development campaigns. And that helps give investors more confidence in catalysts that are coming up. So I think all in, a really positive setup for biotech.
Yeah, certainly interesting, too, as you get back into favor, I think, at least in the last little bit. Let's get into some picks, shall we? First one for you, BioCryst Pharmaceuticals. Take us through this one.
Yeah, so BioCryst Pharmaceuticals, ticker BCRX, we've got a $21 target on this one. And I think this is an orphan disease company focused on hereditary angioedema, HAE for short. So about 10,000 people in the U.S., but they have a product, Orladeyo, already on the market. And this is on about a $600 million plus run rate right now. Stock is trading at about 3 times consensus revenue, but the mid-cap peer group is trading closer to 6 times. So why is the disconnect? Why a discount here? Investors are concerned about the longevity of Orladeyo's revenue tail and how long is that going to persist with other competitors coming into the HAE space. I think this is misplaced, and it's totally overlooking a recent acquisition that BioCryst did of Astria Therapeutics that brings in a late-stage program called Navenibart, another HAE preventive agent, but this one is administered only 2 to 4 times per year. So we're going to get phase 3 data on that early 27. If that looks positive, that's going to dramatically change how we treat HAE. And that's also going to solidify BioCryst positioning in the HAE space already. So I think you've also got another pipeline readout coming up year-end 26 for a different program. I love the mix of commercial and clinical catalysts here. And again, our target is $21.
Yeah, I was going to ask about the clinical part of that too, and talking about in particular. So next year, but it's 2027 in particular that you're looking at the part of this and really where you're going to see some of those results?
Yeah, for navenibart, we will see that in the early part of 27. That's going to be that first efficacy data for navenibart. And then that late 26 readout is for another orphan disease called Netherton syndrome. And I would argue at this point, there's zero in the valuation for that program right now.
Okay, interesting too. How about Viridian Therapeutics? Another one, your second hot pick for the day today. Take us through that.
Yeah, so ticker VRDN, and this one here, we've got a $32 target. This is a pre-commercial name, but that could change pretty soon. They have a PDUFA date for veligrotug, their program in thyroid eye disease, and that's on June 30th. So they've got breakthrough therapy designation, priority review, commercial team is hired. So this is essentially a launch-ready story. And I think what's really exciting about this one is the disconnect here between consensus revenue expectations and historical precedents. So Tepezza is already on the market for thyroid eye disease, same mechanism as Viridian. And Tepezza generated over $800 million in its first 4 quarters of launch. Consensus right now is factoring in about $300 million for Viridian over the first 8 quarters of launch. So love the setup here. Veligrotug, same target, same disease. Both are IV administered, but the Viridian program has fewer infusions and shorter infusions. So a better mousetrap kind of entering the market here for Viridian. And then, you know, the stock has come under pressure more recently after some subcutaneous data came out for elegrobart, their second program. But I think the second REVEAL-2 data readout really more supportive. And it doesn't change anything about the veligrotug story, which is the more immediate catalyst. So again, our target here is $32.
Okay. Maybe a longer horizon one, too. And we talk about gene therapy in lots of different parts of the medical field in particular, but Solid Biosciences, ticker SLDB. Take us through that one.
Yeah, and so this is definitely a clinical stage story, but I think, you know, what's really exciting here is they are working on a next-gen technology for Duchenne muscular dystrophy. And this is really a devastating condition that affects young boys. Currently, I would argue somewhat limited treatment options available. So what Solid is doing differently versus the first generation, it's their capsid technology. So that's the vehicle that's delivering the gene therapy. And I think Solid's approach is a really more muscle-targeted system. So that's de-emphasizing the liver, emphasizing more muscle tissue delivery, which is exactly where you want the drug to go. They've also shown some preliminary data that looks really encouraging in terms of biomarkers, and safety has been uneventful, which is exactly what you'd want to see in this type of story. Now, they do have a phase 3 study already up and running, and the key question here is, would they be able to file for accelerated approval? And now bears are going to tell you that gene therapy can't really win with FDA right now. But I think Solid is taking, you know, kind of a belt and suspenders approach. And they've already started to solicit positive feedback from FDA on different aspects of their program, which is a great strategy, very methodical. They are going to go back soon, have another FDA meeting to really refine what FDA needs to see in terms of endpoints. And then beyond this, we have another program with Solid already advancing in the clinic. So I think over the next 12 months, you're going to get a very more clear picture on the regulatory requirements for 03 and Duchenne, but you're also going to get validation of some clinical data for their second program. So our target here is $16, and I think for investors with a longer time horizon, this is a great idea.
Laura Chico is Managing Director and Senior Biotechnology Analyst at Wedbush. Thanks for joining us today here on The Close. We'll see you back here tomorrow.